Hey, it's Lewis here and welcome back to the channel, and in today's video we're going to be analysing Qualcomm stock. We'll be using TIKR terminal to go through the financials, and then I'll put the cash flows into my DCF and we'll come to a fair value of their stock. Let's get straight into it. So who are Qualcomm? So Qualcomm is an American multinational corporation headquartered in San Diego, California, incorporated in Delaware. It creates semiconductors, software and services related to wireless technology. It owns patents critical to the 5G, 4G and all those others mobile communication standards. The company itself was established in 1985 by Irwin Jacobs and 6 other co-founders. So yeah, the company itself is listed on the Nasdaq and it's a component of the S&P 500 index. Now let's have a look at the sales for Qualcomm, and as always we will start with the sales per business. So Qualcomm CDMA technologies make up 81% of sales. I'm guessing this means chips related to 4G and 5G. Technology licensing, 19%, and the others are minimal, so no point even talking about them. Sales per region, so China makes up 67% of sales, other foreign 18%, South Korea 7%, the US 4%, and Ireland 4%. What's interesting here is that the US is only 4% of sales, which is very surprising. very surprising. It must be something to do with the amount of phones in China, and Qualcomm have chips in every phone on the planet, so that's what it's likely related to. But some interesting insights there anyhow. Now let's have a look at the financials for Qualcomm, and as always we're using TIKR terminal to do this. Let's look through the three main financial statements and then the financial ratios. 5 years worth of data. Let's start with the income statement. So over the past 5 years, revenue has increased by a fairly decent amount. So before 2021, income was relatively flat, let's be honest, not much growth going on, single digit. But in 2021, massive growth there, which is pretty crazy actually. What's that, 43% growth from 2020, so that's mad. So let's have a look at what net income has been bringing in. So yeah, over the past 5 years, that net income has, let's say, tripled, quadrupled, not quite quadrupled, but nearly tripled or quadrupled, so looking pretty decent anyway. Very profitable business here. We will see if 2021 numbers last, but yeah, it's looking profitable, so you can't really give them too much stick for that. Shares outstanding wise, we have been buying back shares, which is very good for us as shareholders. As long as the shares have been at a fair price, this has been a very good capital allocation decision, and we'll see if that has been the case later on. Cash on hand and short-term investments actually decreased over the past 5 years. I wonder what they do all the cash from 2017 to 18. That's a big drop. Hopefully they've invested it well. Long-term debt. So long-term debt's actually decreased over the past 5 years, which is something I love to see. I love it when companies pay back the debt. It's just a good thing to do. Return earnings have decreased a bit over the past few years. So something to look at in the financial statements to see why the return earnings decreased so much. Could be a multitude of reasons why that's happened. Cash flow statement now. So the cash flow statement, the main figure we like to look at is cash flow from operations and capex. These two figures combined make free cash flow. Free cash flow is the most important figure in value investing, in my opinion anyway. So free cash flow, we can see, has increased over the past 5 years, which is lovely. You can see capex is increasing over the years as well. They must be reinvesting into their business and trying to create better products. Bear in mind, if 2021 wasn't here, free cash flow would have been lower. So just got to bear that in mind. Dividends. So we've been buying back total debt repaid, repurchasing shares, and they've been paying dividends. Dividends have been not growing, relatively flat. But if we've been buying back shares and keeping the dividend the same, it means you get more of a dividend anyway if you want the shares, if that makes sense. So we'll go to the ratios now. I like ratios because it tells a bit more of a story in the financials. Numbers on their own, you can only compare to previous years, but let's have a look at the ratios anyway. So return on capital for this business is pretty damn high. The past few years has been really good. Bit all over the place, but it's looking high anyway. Hopefully they can keep it consistent, because I like consistency really. 37% noise, fantastic. Gross profit margins, once again, a little bit all over the place, not like a consistent figure, but they are high nevertheless. Net income margin as well, apart from 2018, looking solid, 27% in 2021, which is pretty damn high. Can't complain that much. Current ratio above 1, lots of liquidity. Dividend yield is 2.5% if you're interested in that. The CCC is below 60 days, which is I think is a good sign. Long-term solvency, so debt to capital is currently 62%, which is a little bit high for my liking, but if it's manageable, we can accept that. But it's something just to bear in mind. There's a little red flag for Qualcomm. Interesting stuff there from TIKR Terminal. If you'd like to use TIKR Terminal, head into the link in the description down below. Sign up to TIKR Terminal, let me know what you think. Great bit of kit for analysing companies, all sorts of different sections on here. Analyst estimates, you've got transcripts from earnings, and you've got a global stock screener which has most of the stocks listed in the world, so it's a fantastic little platform. So head over to TIKR Terminal and happy. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions, you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you now. Let's have a look at the genuine impact stats for Qualcomm, and as always, we will start with the value and quality metrics. So value is looking bad, so it's not looking good value-wise, it's looking a little bit expensive. Take that as you will. Quality-wise, it's looking very good. One of the highest quality stocks on the platform, which is really, really good stuff. No complaints there. Now we'll go into the dividend section, and the dividend's looking good. Ranks one of the highest on the platform for dividends. Past growth has been good, and future growth is looking very good as well. So it looks like there's a lot of good growth prospects for the business. So some interesting insights there from Genuine Impact. Now let's have a look at my analysis checklist for Qualcomm, and as always we will start with my first pillar. So I want a company to be profitable, high return on capital using low leverage. So return on capital for this business 5-year average has been 27%. Lovely stuff, can't complain much there. Profit margins as well are way above where I want to see. Simple as that. It's a profitable business, really, really love that stuff. I think this has been brought down a little bit by, I believe 2018 was a negative profit margin for whatever reason, so something to look into. Why did we have a negative profit margin? Could be many reasons why. Look into the financial statements and you'll find out. It's about average is being brought down a little bit, but it's what it is. Free cash flow margin though, probably more important, let's be honest, 21%. Free cash flow is a lot harder to manipulate than profit, so I'd probably go with the free cash flow margin. It's a lot better indicator of how they're doing. Current ratio above 1, lots of liquidity in the business. We've got more current assets on hand than current liabilities, so short-term obligations are covered. Cash conversion cycle is below 60 days, so that's a very good sign. It means the cash runs through the business very quickly, always very good. You want that in a business. Total debt to capital though, as I mentioned earlier, is 62%. A little bit too high for my liking, but if the business overall is good quality and it's growing, they can grow out of this debt. You just want to make sure we don't have lots and lots of debt burdening the business. I think for Qualcomm they'll be fine, but just something to take note of. Proven ability to grow wise, everything about return earnings is in the green. I wonder what this minus 20 odd billion is for. Got to have a look to see what it is. I don't actually know from the top of my head, so I would have to have a look in the financial statements. Why is return earnings dropped by 20 odd billion? Great capital allocation. So I've been repaying back debt, buying back shares, dividend growth. I've actually not increased for dividend, so take that as you will. Good acquisitions wise, just not a novelty one, but measuring good acquisitions is quite a hard feat to do because acquisitions are very, very hard to get right. But I think gain on asset sales versus asset write-downs and goodwill impairment. If you've got lots of goodwill impairment and asset write-downs, you're not allocating capital correctly. But in this case, they've had some gains on asset sales, which is just a good thing for the business, really. Quality score overall of 80%, so very solid there for Qualcomm. Buy at a fair price, the most important pillar of all. Doesn't matter how good quality it is. If you can't buy at a fair price, doesn't really matter, to be honest. So yeah, P ratio is 16 and price to free cash flow ratio of 20. And my DCF valuation for a 10% return, I'm getting a share price of $129 per share, which would be, the share price would have to fall by 16% to get there. Current share price is $154. But yeah, I'll have a look at my DCF now. And I have taken my free cash flow figures. Well, I did use them from Market Screener / TIKR Terminal. The figures come from the same place, S&P Global. But I thought they were a bit optimistic, to be honest. They were showing like 14 billion free cash flow for 2024. I thought it was a bit steep. The current economic environment, I'd rather be conservative. I do believe they're going to grow to free cash flow, so I'll just use a flat 10% growth for the next 3 years. I think that's pretty conservative, to be honest. So yeah, simple as that. That's my free cash flow, 10% return, company value just into net cash of 126 or 129. I'm probably going to risk figure, to be honest. $129. But you're getting interest in Qualcomm. Currently, it's $154. A few like a month ago, it was 120. So it's been close to. So yeah, it's been very close to 10% return, in my opinion, very, very recently. So yeah, going to add this to a watch list and get looking, because I think Qualcomm's a good quality business. And yeah, have a look at a few little niggly bits, like the return earnings decreasing so much, big loss in 2018. But yeah, apart from that, Qualcomm's looking fairly decent. You get it at a good price, good quality business, dividends, share buybacks, lots of stuff I like to see here. So some interesting stuff there from Qualcomm, indeed. So there we have it. That was my full stock analysis for Qualcomm. If you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.